If you have ever tried scalping fast-moving markets, you already know how aggressive and unforgiving they can be. One wrong entry and you are out instantly. Hello traders, welcome back to ComLucro. In today's video, I am going to show you a scalping trading strategy and how professional traders trade these types of moves on the 1-minute and 5-minute charts. These are the exact setups I would rely on if I had to trade this kind of market every day. Each one follows clear mechanical rules, and I will break them down step by step. By the end of this video, you will have a complete roadmap to approach scalping with more clarity. If you enjoy this kind of content, make sure to like the video, subscribe, and turn on notifications so you do not miss what comes next. And let us know in the comments what topics you want us to cover next. You will also find links to our trusted partners in the description. When you use those links, you help support the channel and keep this content moving forward. Before we dive into the scalping strategies, it is important to understand that this specific setup works best on assets that behave in a certain way. Some markets are better suited to liquidity sweep-based strategies, while others tend to react more clearly to higher time frame levels, supply and demand zones, order blocks, and fair value gaps. Assets like gold are a strong example of this type of behavior, because they often move from one key area to another with very clear structure. Because of that, building a powerful scalping strategy means focusing only on setups that follow higher time frame delivery as the main source of confirmation. With that in mind, let's move into the first scalping strategy. To apply this correctly, you need to work with two time frames. Start with a higher time frame to analyze the overall market condition. On this time frame, you should mark manually on the chart the liquidity sweep, the break of structure, and the order block connected to that move. Then, you zoom in to a lower time frame to follow the higher time frame delivery, and watch for reversal or confirmation signals. At that stage, you wait for your entry model to appear before opening a position. Now let's go step by step and see exactly how this setup plays out. To begin, you need to identify a key liquidity sweep, or liquidity grab, together with a break of structure on the higher time frame. Everything here should be marked manually on the chart. For this video, the focus is on understanding the logic clearly and identifying each part of the setup step by step. In this bullish example on the higher time frame, the first thing you want to find is a bullish liquidity sweep, or liquidity grab. In simple terms, you want to see price take out a key level, reverse immediately, and then confirm that reversal with a break of structure. From there, mark the setup manually on the chart. In the bullish case, this means spotting the moment price sweeps below a recent key swing low, shows a strong rejection to the upside, and then delivers a bullish break of structure. After that, the next step is to mark the order block that initiated both the liquidity grab and the break of structure. That area becomes your higher time frame point of interest. More often than not, price revisits this block where it behaves like a demand zone, and smart money steps back into the market. For those who may still be wondering, an order block is a decisional zone where large volumes are positioned right before a major expansion. Because of that, price often reacts or reverses when it returns to these areas. In a bearish scenario, a bearish order block is the last up-close candle or series of up-close candles formed right before a strong bearish move that causes a break of structure. By contrast, in a bullish scenario, a bullish order block is the last down-close candle or series of down-close candles formed just before a strong bullish move that leads to a break of structure. Once the order block is marked, the next step is simply to wait for price to return to that zone. That is where your potential trading opportunity begins to form. Once price reaches the order block, the next step is to zoom into the lower time frame and closely watch the price action for signs of a reversal. Those signs could include a market structure shift, a change of character, or other reversal patterns such as an inverse fair value gap or an R pattern. After that, the next thing we want to find is a violated fair value gap that transforms into an inverse fair value gap. That becomes our first confirmation. Once the inverse fair value gap forms, it often starts acting as a new support level, giving us a strong area for a potential buy entry. If a market structure shift appears at the same time, that adds another powerful layer of confluence and makes the setup even stronger. With both confirmations in place, we can expect price to retrace back into the inverse fair value gap, which is now acting as support, before continuing higher toward the next pool of buy-side liquidity, where we can plan the entry. With this model, you have two entry options. The first option is to enter immediately after the inverse fair value gap forms. In that case, you open the position at the opening of the next candle, with the stop loss placed below the most recent swing low. The second option is to place a buy limit order at the highest point of the newly formed inverse fair value gap, and wait for price to retrace back into the zone and trigger your position before moving toward your take profit. For the target, you can aim for the nearest buy-side liquidity on the current time frame, or if you're looking for a larger move, you can target a key level on the higher time frame. This second entry approach often gives you a better risk-to-reward ratio because it's slightly more conservative. In cases where price has already started moving in my expected direction, my first position is already running in profit, and there is still enough room for price to keep moving higher. I often look for a chance to add another position as a continuation setup. That usually happens when price forms a new bullish fair value gap during the next bullish leg that follows a new break of structure. In that situation, the next unmitigated bullish fair value gap becomes our second entry point. From there, we can place a buy limit order at the highest point of that fair value gap, with the stop loss placed a few pips below the most recent swing low. Naturally, the exact opposite logic applies in a bearish scenario. As mentioned earlier, to get the best results with this trading plan, especially when trading gold, you need to work across two different time frames. The most effective higher time frames for identifying this setup are the 30-minute and 15-minute charts. Once a potential setup is identified on the higher time frame, you can move down to lower time frames, such as the 5-minute or even the 1-minute chart, to execute the entry. Now let's continue with the second scalping strategy. This setup also works with two time frames, the 1-hour and the 5-minute charts. On the higher time frame, we analyze the overall market condition. At this stage, we are looking for unmitigated high-quality supply and demand zones. From there, we zoom into the lower time frame to follow the higher time frame delivery and look for reversal or confirmation signals. This is the stage where your entry model needs to appear before you open a position. Now, let's go step by step on the chart and see exactly how to apply it in a bullish scenario. To begin, confirm that price is in an uptrend and that buyers are in control of the market. To do that, you need to identify at least two consecutive bullish breaks of structure. Start by marking the structure manually on the chart. Once price forms two consecutive bullish breaks of structure, shift your focus to the most recent one. From there, trace back to the origin of the bullish expansion move, the move that caused the break. That origin point is what defines the demand zone. The next step is to mark the most recent unmitigated demand zone on the higher time frame. After that, wait for price to return to that area. Once price taps back into the zone, move down to the 5-minute chart and closely observe the price action for signs of a reversal. This will act as your first confirmation before you begin looking for an entry. That confirmation can come in the form of a market structure shift or a clear change of character. Either way, it becomes your first layer of confirmation. What this market structure shift tells you is that the temporary bearish move is likely coming to an end, and that bullish momentum may be returning. At this point, price is expected to align again with the higher time frame trend. Once that bullish structure is confirmed and we expect price to continue higher, the next step is to look for a buying opportunity. At this stage, you need an entry model to form. For the first entry, I usually look for a bullish breaker block forming inside the higher time frame supply or demand zone. For a valid bullish breaker block, price should first form a swing low, then a swing high, followed by a lower low. After that, you want to see a strong expansion move to the upside that breaks structure and confirms the shift. In this situation, the up-close candle, or group of up-close candles, formed between the first swing low and the swing high becomes your breaker block zone. That is the area where you plan your long entry. Everything here should be marked manually on the chart, step by step, exactly as shown earlier. From there, the next step is to place a buy limit order at the highest point of that breaker block and wait for price to retrace back into the zone. For your take profit, you can target the nearest liquidity on the current time frame or aim for a key level on the higher time frame if you are expecting a larger move. In situations where price has already moved in your expected direction, respected the demand zone, and your first position is already in profit, you can also look for a continuation entry when a new break of structure forms. This typically happens when price creates a new bullish fair value gap during the expansion leg of the new break of structure. In that case, the next unmitigated bullish fair value gap becomes your second entry zone. From there, place a buy limit order at the highest point of that fair value gap, with the stop loss positioned a few pips below the most recent swing low. On the bearish side, the same logic applies, just in the opposite direction. With that covered, let's move on to the third scalping strategy. Just like the previous setups, this one also requires working with two time frames. Begin with a higher time frame, such as the 4-hour or 1-hour chart, to analyze the market structure and identify a clear higher time frame change of character together with an unmitigated fair value gap connected to it. After that, move down to a lower time frame, such as the 15-minute or 5-minute chart, depending on your preference, to look for reversal signals, confirmation, and eventually a proper entry model. Now let's go step by step and break down exactly how to apply this on the chart. The first step is to analyze the higher time frame structure and determine whether price is in a strong uptrend or a strong downtrend. In a bullish scenario, start by identifying a strong downtrend. To confirm that downtrend, price should form at least 3 consecutive bearish breaks of structure. On the other hand, to confirm a strong uptrend, price needs to form 3 consecutive bullish breaks of structure. Once that is clearly marked manually on the chart, the next step is to look for a higher time frame change of character. When price breaks and closes above the most recent break of structure high of a strong downtrend, that signals a bullish change of character. This suggests that sellers are losing control and that the market may be preparing to shift direction. Once this shift in structure is confirmed, and we expect price to move higher, the next step is to look for a buying opportunity. At this stage, focus on identifying a bullish fair value gap that forms within the change of character leg. After marking the higher time frame change of character and its fair value gap manually on the chart, move down to the lower time frame and wait for price to return to that higher time frame fair value gap. Once price enters the zone, closely observe the price action inside the gap and look for signs of rejection. That reaction confirms that price is respecting the higher time frame imbalance and gives you your first layer of confirmation. From there, the next step is to identify a violated fair value gap that turns into an inverse fair value gap, either inside the higher time frame fair value gap or just outside it after the rejection. This becomes your second layer of confirmation. When this inverse fair value gap forms, it often acts as a new support level, and this is where you begin planning your long position. At this point, the focus shifts to execution. To enter the trade, you have 2 options. The first option is to enter immediately after the inverse fair value gap forms inside the higher time frame fair value gap. In that case, you open the position at the opening of the next candle, with your stop loss placed below the most recent swing low. The second option is to place a buy limit order at the highest point of the newly formed inverse fair value gap and wait for price to retrace into the zone and trigger your position. For your target, you can aim for the nearest buy-side liquidity on the current time frame, or if you expect a larger move, you can target a key level on the higher time frame. It is also important to remember that you can always add extra confluence or confirmation factors to this setup to improve its win rate, depending on your trading style. For example, you might require price to fill at least 50% of the higher time frame fair value gap, or wait for additional confirmation signals such as an RSD formation before entering the trade. Please also remember that the mission of the ComLucro channel is simple. We focus on giving traders clarity, confidence, and structure, so market decisions are made with discipline and intention. On this channel, you will find complete courses built as a true trading masterclass. We teach market structure, higher time frame trading, and supply and demand, always focused on understanding price behavior and executing with a professional mindset. We also go deep into trading psychology, risk management, and consistency, because trading is not just about charts. It is about mindset, discipline, and structured execution over time. There are no shortcuts. Real progress comes from continuous learning and practice. Our main courses include Smart Money Concepts, Technical Analysis for Day Traders, Trading Psychology, and the Wyckoff Method course. Alongside our courses, we share lessons and insights from some of the most respected names in trading, including professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, and Larry Williams, whose experience has shaped how traders understand markets today. So, if this video helped you gain more clarity, leave a like. It helps this content reach other traders who are on the same journey. Make sure to subscribe and turn on notifications so you don't miss our latest lessons and insights. Now, I would really like to hear from you. Which concept in this video made the biggest difference for you? What topic would you like us to cover next? Leave a comment below and let us know. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It is a simple way to support the channel and a smart investment in your own growth as a trader. Thanks for watching, and I will see you in the next video.